14.2%. Just go to list.
So what I do is let us do this quickly. Okay, so I'll put it 1999. Okay, but you can see you cannot go. It is saying that September 17, 2007 only you will get the data. Okay, so 2007 I have to put here. And the 17 September is which month it is? 9th month. September 17 they are saying, so I'll put 18th data. You can see it is taking up now. So done. So weekly is there here. So I'll download this. So I'll take up this value and I move to my sheet. I go to my sheet here. Quickly let us do because we know how to do this, right? So this is Nifty 50. I call this as market return. So that is this minus this. So remember this is a weekly data. So I'll do it in one step. So we want to compute CAGR return. So +1. So geomean, let's see whether it works here. It's working. And this multiplied by how much? This is weekly return multiplied by 52 here, right?
Yes.
So 9.09 I got it. So I go here and I put is equal to market return. I'll click this. Clear everybody? So cost of equity, let us compute now, is equal to RFR plus beta times risk premium is market return minus RFR. So I got clear everybody? 10.41. If Sharad Kumar has put CAGR till date, okay, 14.2% till date. So till date means which date it is? Today's date it is?
Yes, sir.
Okay, so then you can take that as a proxy if everybody is okay with that. So now, anyways, you know how to compute this, right? So I'll 14.2, right? So 14.2%. %. 14.2%. So return on equity is 26.02%. It is.
So I think, sir, starting is RFR only, no?
Yeah.
So it won't be 14.2.
This is RFR. Okay. So risk-free rate multiplied by beta. Just see whether I'm right. So return on equity is 18.91. I'm getting it. If I take 14.2 as my Nifty is written. Okay. $14.2 since from inception. Is it fine, class? So tell me now which one we are supposed to be giving more weightage. You can see 8.13 is the return on equity we are getting here through Gordon's model. So return on equity, this particular model should be given weightage when your company is predominantly giving you dividends. Okay, then only you should be going for the Gordon's model. Otherwise, for all the other companies, this really works well. Okay, so if you ask me the academic perspectives, many of the academicians are actually okay with computing CAPM model. So please keep in mind that CAPM model, though it has got many other limitations, okay, so this is called as the best model for computing the return on equity as on date. Many multi-factor models also got evolved, arbitrage pricing theory, and many other multi-factors models, comma French, many models are there, but still CAPM is actually highly regarded as the best method to compute the cost of equity. Okay, so this you have to be keeping in mind. So let us go further. What was
Sir,
the
return of market, you have returned from inception, but I think this should be last 5 years, no? 50-50.
Since 2007, it
he should be
is
taking
9.09.
since from the inception, you should be taking for the market return. Okay, for the computation of return of the market only. Fine. So next is any other doubts, class, before we move on to the next. So we have computed cost of equity now. So now we have understood how this cost of fund has been computed here. We have assumed here. Now you came to know that. Okay. Next is rather cost of retained earnings will be same as cost of capital. Now I am moving on to the cost of debentures. Fine. Cost of debt, in other words. Okay. So I am writing here cost of debt slash debentures computation. So let us discuss how to compute this. Okay. So if your debt is publicly traded, then YTM of your debentures will be equal to pre-tax cost of debt. So please make a note of this. What is the meaning of this, class? Can anybody tell me? Please go through this, read this. Anybody would like to say any answer, or shall I explain? What is YTM?
Sorry, what?
What is YTM?
Yield to maturity.
Yeah. So YTM is equal to yield to maturity. Do you know where we discuss this? We discuss this while understanding yield to maturity with respect to valuation of bonds. Right? Okay. So yield to maturity quickly I'll compute. Okay. So when this debentures have issued date. So first of, I'm just making some assumptions here. 2015 maturity is 31st/12/2030, 15 years bond it is, debentures what the company has issued. Issue price was 100 rupees. Redemption value will be how much? Redemption value will be 100 only. Coupon rate is how much? 8.5. We'll make it as 9.5 just. Okay, so coupon rate is this much. So current market price is how much? Market price is 102 rupees and 40 paise, right? We have taken for Prashant Limited. Okay, so can you compute YTM now? Quickly. Compute this YTM. How to compute this YTM? Is equal to, what is the function? Yield. Okay, so yield is settlement is, when is the settlement? It is issue date, it is, right? Issue. Maturity is this. Coupon rate is 9.5. Price is 102.4. Redemption value is 100. Frequencies, it's a semi-annual bond. Okay, so once in, there are 2 times this particular coupon you are going to receive. Okay, so you can see it is not coming of value here because we have not put the date the way it is supposed to be put, right? So we should be very careful while putting this. Okay, so is equal to date. Here is 2015, 1,1, correct? Next is date. Here is 2030. Month is 12th, 31st. So still it is not coming up. Okay, so I'll change this.
9.5% maybe because
9.5%. Coupon rate. You
Coupon
have
rate
to
is
not-
9.5%. No?
yes. But mine is coming, it's 6.68 it shows.
Why is it so? Just
Sir,
check
I don't know.
whether I made any mistake or you made a mistake.
Sir, I got 9.21.
How many of you got? Just put it in the chat box as yes. If it is matching, then I think we are in the same.
9. Yes, I have also got 9.21%.
Okay, so let us fix. So 9.21 is what is this? This is
Year Y2M, YTM.
YTM it is, but this is cost. The pre-tax cost of debt will be equal to.
This is year to maturity, right? So it should be in precise, numbers, not percent.
It should be in percentage only because it yield is always in percentage terms.
No, YTM is year to maturity.
Yield,
That's why.
not year.
Yield to, okay, right.
Yield to maturity, you can see here. I have written here.
Yes, right. Sorry.
So pre-tax cost of debt is this much. Can you tell me how much is post-tax cost of debt? How much? If you know the tax rate in India is equal to 25%, corporate tax rate. Can you compute post-tax cost of debt now? Is equal to 9.21 multiplied by 1 minus tax rate. Okay. This is how we should be doing it. Can you do quickly? So how many of you got 6.91? Just put it in the chat box as yes. Sachin, yes. Okay. Anybody?
explain this again. Pre-tax on vegetables.
Okay. So the pre-tax cost of YTM, the yield to maturity is 9.21. Okay. And that is actually called as pre-tax cost of debt. It is. That is before tax. This is what it is, the cost of debt it is. So normally when we take into consideration, a post-tax cost of debt. So we have to net out the taxes because you know that the interest on debentures we are going to debit to the income statement. When we debit into the income statement, what happens? We get the tax advantage, that is tax savings. So because of which we are actually netting out the tax rate. And this is what is our net to net cost of debt it is. Is it clear? Why we are going to subtract the tax? And
Because it reduces our profit.
it is
That's
not
why.
going to reduce our profit. It is going to reduce our cash outgo because there is a tax savings which is coming up there. Because you know that in the first class or second class we discussed, I think in physical mode when I came to Rohtak, your taxes, your whatever the debt instrument which you have got it, you're actually going to be save taxes on it because you're going to debit that to the income statement before arriving at the income tax because it's an allowed expenditure. Do you remember this?
Yeah, same thing I am saying. It will reduce our profit. We have to pay interest of that.
No, we have to pay.
Our corporate tax will be reduced.
Taxes will be reduced. That is what I'm saying. It is not going to reduce the profits. It is going to reduce your tax outgo. What you are supposed to pay as tax, that is actually slashed by 25%. Na? But in case of dividend, you'll not be able to save that 25% because it is not been debited to your profit and loss account. Dividend is not debited to your income statement, right? Clear?
This is our expenditure. That's why tax will be reduced.
So 9.21, but effectively how much you are paying, how much is the cost of debt for use? 6.91 because we are subtracting 25% tax rate because of which that savings is happening. Clear? So this is how we should be doing if the debt is publicly traded. So what if the debentures are not publicly traded? Because you will not get the market price at all. That 1 or 2.5 you will not get at all. So how do you compute? Because in the Indian context, okay, so 99% of the corporate debt is not publicly traded. So how do you compute the cost of debt in that case? Okay, so RE, now I'll call it as RD because it's cost of debt it is equal to interest expense divided by total debt. This is what the modification you should be doing it. And this is actually called as what? And for this, what you have to do is whatever you get it percentage minus tax rate of the corporation. Okay, if you do it, you will get the. So now you tell me for Prashant Limited, let us assume that interest expenses, you know, it is available in the income statement as a debit item. Okay, so 500 crores is the interest expense, and the total debt means what? What do you mean by total debt? Short term plus long term, both is actually called as total debt. It is. ST means short term, LT means long term. Both, assuming that it is 6,000 crores. So can you tell me how much is the cost of debt? So cost of debt will be how much it is? 500 divided by 6,000 minus of multiplied by 1 minus tax rate. Shall I do it? I can change this equation as well if it is confusing. 1 minus tax rate means I am reducing the tax rate, right? So I'll just change this multiplied by 1 minus tax. Is it fine? It is very simple calculation. If your debt is not publicly traded, why? If the debt is not publicly traded, then you'll not be able to compute the YTM in that situation. Okay, when you do project for your own companies, you'll come to know that many of your companies' debt is not being traded in the open market. Okay, so in that situation, how to compute the cost of debt is using this shortcut method. Is it clear, everybody? This is second method of computing the cost of debt.
Yes.
Shall we go ahead with the next one? So now we have understood how to compute the cost of debentures. So last one is cost of term loan. How to compute cost of term loan? Okay. So I'll write here cost of term loan computation. Yeah, anybody would like to, now we have understood how to compute cost of equity, cost of debt. Can somebody throw some light on how to compute cost of term loan? Any ideas, just in case if you have it? Basically, it is a bank loan. Okay. It is an 8-year loan you have taken. 8-year loan taken 3 years ago. Which means what? You have to repay this in next 5 years. Tell me now how to compute the cost of term loan. Okay, assume that when you have borrowed this particular loan, at that point in time, interest rates were less, because of which you could borrow this loan at 7.5% only. Because 3 years ago, your CRR was less, the market rate was less. That is the reason you borrowed at the rate of 7.5%. Okay, so tell me now how to compute cost of, all the information is given to you. Tell me how to compute cost of term loan. Think and tell me, because if you think, you'll get the, when I tell you the answer, it is going to be more satisfying. Trust me.
Should it be the interest that we paid and the total amount of the debt of the loan?
We have to multiply loan amount and
That should
annual
be a
interest
ratio.
rate.
That should be a ratio of interest paid and the total loan taken, probably.
But still, you'll be paying 7.5% only, right? If it is a fixed
But something could have been paid, isn't it? Also.
No, 3 years you have been paying EMIs. Your part of your principal amount is also repaid, right? That is what you are saying.
Yes. Yes.
But still, 7.5% is your loan rate.
But will it not
So
be
a loan
as
amount,
the formula for that?
Yeah, Dinesh sir, go ahead.
Sir, will it not be same as the formula which you've written for the cost of debt? The interest expense by total debt into 1 minus tax rate.
This can be done. Okay, this is one way, one method of doing. One way of looking at it is this. But do we have any other better ways of doing it for term loans? Think about it.
amortization.
The cumulative interest of 8 years plus principal.
So you are again coming out with again absolute number, not the percentage. We want some percentage, right?
7.5 only.
Mayank is saying 7.5. Is it so? Okay. So I'll tell you, it is out of the box thinking again. It is. Please hear me out clearly. What I'm thinking is I'll go to same bank. I'll ask for, since 5 years more remaining. So what I ask is I ask for a new quotation from the State Bank of India, assuming that I have borrowed this from the State Bank of India. Now State Bank of India is quoting me 9.5%. Assume that 9.5% it is quoting. And this becomes my pre-tax cost of term loan. Pre-tax cost of term loan. And I can't do this.
No,
for
why it's addition? That would be for additional loan. No, this would have been 7.5% if it's not flexible.
It is not flexible, but you are actually computing this WAC. But now the things have been got changed in the last 3 years. The same logic we applied for the cost of equity also, right? What we have done while computing we have taken market value weights. We should have taken book value weights, right? Think about it.
Correct.
Okay. So 9.5% is a new quote which we received from the bank, that is from the State Bank of India for the next 5 years. And the duration of this loan is also 5 years because 3 years already got elapsed. That is the reason I have taken the quotation from the bank. In the last 3 years, what must have happened is interest rate must have gone up or gone down. And the market credibility of your company must have gone up or gone down. So based on which the bank takes into consideration of all those aspects, and the bank is actually going to quote the new rate for you. And that particular rate should be your pre-tax cost of term loan. That is a logic what I am actually saying. It is not only because of the interest rate fluctuations. Okay, it may be some credit, it is something to do with your credit rating as well.
And what will happen with the difference of amount?
No, I am not paying 9.5%. My cost of funds for doing the cost of capital computation, I am taking up 9.5% only. I am paying at 7.5% only still.
Okay. Got it.
Current value of interest.
I am only paying at 7.5%, but cost of capital computation, at least I should factor in that 9.5%.
Sir, assuming that CRR will change or companies' credit rating will change.
Assuming that my cost of debt has been got changed, because I should be taking the current market, what is running market interest rate, the way we have considered for the cost of equity. That is the reason we are considering the same with respect to the cost of term loan as well.
Sir, this is okay if the interest rate increases, but what if the interest rate decreases? Let's say today
if interest rate increases, let's say for example, your creditworthiness for the last 3 years it was not good. Now it has gone down to, let's say, 6.5%. Please take 6.5%.
No, but the outgo of interest and all are anyways higher, right?
It is higher, but it is 6.5 is a new interest rate, right? Based on your credit worthiness and what it is actually happening. So 6.5% ideally be taking. Or if you're not convinced with this particular argument, you take higher of the both.
No, but cost of the capital can be worked out, Dinesh. That's what I'm saying. That is different other than paying.
What I'm saying is that the capital which you have borrowed from the market, how do you put a price for it? What was that cost of that capital? Now, one way currently, as Sir has told, that you can get a quote from outside. Okay, how much are you offering? That is okay. But if that quote is less, it is 6.5. You're anyways paying more than that. So your cost is not 6.5. Your cost is more than that because you're paying more interest and everything. Either you refinance.
Yes, I understood. Because you're saying that if you take 6.5, but you're paying more.
Yes.
Okay, then that is what I'm saying. You take higher of the both, higher among the both, which means instead of 6.5, still you can take it 7.5, and you can say that I am more conservative in this way. Okay, so my intention is you have to understand the concept as is. That's it. You can play around with the concept once you have understood it. Now you are thinking that 6.5. If you take 6.5, you are thinking that it is not the true representation of your cost of funds because I am paying more. That is what Dinesh sir is saying. Is it not? Actually, I am paying 7.5, but if I take 6.5. That is not actually going to be true representation of my cost of term loans. That is what Dinesh sir is saying. Okay, in that case, you take higher of the both. 6.5 versus 7.5, which is higher? 7.5, I'll take that because I want to be more conservative in my approach. That way also it can be done. I hope I answered your question, Dinesh sir. Okay, fine. So next is what cost of term loan. Can you tell me quickly how much is now I take this 9.5 is my pre-tax cost of term loan. Post-tax term loan will be this multiplied by 1 minus tax rate. That's it. So this is my post-tax cost of term loan. You take this and compute this. So we have completely discussed about all the components with respect to how to compute WACC. So how many of you understood how to compute WACC now? After going through all the parameters, how to compute each cost of funds we have discussed. If you have got any doubts with respect to how to compute WACC or maybe any components, you can ask me now. Otherwise, we'll move on to the next.
What have we done for this post-tax cost of term loan? Can you please just show it once?
Minus tax rate.
Okay.
So during back calculations, we have to take this rate.
We should have taken 7.125, not 9.5 actually. There I did not explain at that point in time the tax effect and all. I'm explaining here actually. Cost of debt for me is always post-tax.
So next, should we revise that back calculation now?
No. Cost of debt for me is post-tax always. I have assumed that is the post-tax. Sir, what I am saying is, this is an assumed figure, right?
This is understood, sir. So, in fact, when for the cost of debt debenture, you wrote that, if debt is publicly traded, your YTM of the debt is pre-tax cost of debt.
Correct.
So, in case of publicly traded, it is pre-tax. Otherwise, it is post-tax.
In both the cases, it is always post-tax, right? Let me go again.
Yes, you see the blue line. Blue, you have written in blue there up just up. This is okay, sir. Understood. This calculation is understood. My only doubt is that if you go up when you've written in blue, one more up, yes. If your debt is publicly traded, then that is for YTM.
Please read it blue line.
Understood.
It is equal to pre-tax cost of debt. That is the reason I wrote pre-tax cost of debt clearly. Minus.
The definition is for YTM, not for cost of debt. Understood, sir. Thank you.
Okay. Hope WACC is completely clear. No doubts at all.
Right.
So let me confuse now.
Sir, one doubt is still there.
Okay, go ahead.
Cost of funds, you have not taken these rates which you have calculated now.
No, sir. I'm telling you that these are the assumed rates only.
Okay.
To make you understand, I actually otherwise you'll be clueless. Why are we computing all this? So because of this, first I given you a blueprint of what we are doing in this session, 2 sessions, and I computed all of them separately.
Okay.
So term loan is one.
Our aim is not to actually come up with this. Our aim is to compute and understand how to get this.
In real scenario, in cost of funds, we have to use these figures which we have calculated.
Yes, you're right. Yeah, Preeti madam.
Yes, for term loan, it is the loan that we take from bank.
Yes.
Okay, so can you please go where you calculated the term loan? Yes, so you mean to say we had taken a loan for 8 years and after 3 years we recalculated. We asked from the bank for
No, madam, I'll tell you what I said. So it is 8 years loan we have taken, but 3 years got over as on date. There are 5 more years left for maturity, which means we'll be paying out this term loan in next 5 years. That is what is the assumption we made here for class understanding, I'm saying.
But we pay that loan amount means after 8 years, not yearly, right?
After 8 years, we will pay. If the arrangement is so that you will be paying an installment like an EMI, that may also be there.
Okay.
Okay.
So after, yeah, what were you telling after 5 years?
3 years got over. Another 5 years means 5 plus 3 is 8. Total term loan you'll be paying out in 8 years.
Okay. And then after that also, sir, what did you say that why did we take the means higher one, and then from where did we get that 7.5 and 9.5?
This is 7.5. When we took the loan, it was 7.5% 3 years ago. Because at that point in time, the market interest rate was less. At the same time, your credit worthiness of your company, Prashant Limited, would have been much greater. That is the reason you would be able to borrow at the rate of 7.5%. That is the reason I have given you 7.5%.
So the more the credibility, the lesser would be the interest rate, right?
That's right.
So 7.5 is the new one. Or the earlier I had
9.5.
credibility. Okay.
9.5 was new one because maybe your company's credibility must have gone down. Plus
Okay.
the market interest rate must have also gone up.
Okay. So for my
Higher of them.
I have to take the higher one in consideration. I don't know what
Yes.
exactly would be going on.
Higher of them.
Okay.
Okay. So Nirankar is asking why we subtracting 25% in post-tax cost of term loan calculation. What is the answer for this? Because it's a pre-tax, right? The moment the quotation you receive, that is pre-tax it is. So you have to subtract out the tax rate 25%, right? That is the reason we are subtracting. Fine.
So every time we will subtract 25% for any case. Means how
only
will
with respect to debt.
conclude
If it
that
is-
this
Suppose
percentage we
you
have
are
to
actually
subtract.
paying taxes, right? You're paying taxes, and there's that tax savings which has been happening to the tune of the corporate tax rate. Hope I answered your question.
Yes, sir, but still I am unable to catch this. Means how we will
Dinesh
conclude
sir, can you please
that
explain
what
to Nirankar
percentage
sir
will get
why are
subtracted?
we subtracting 25%?
So Nirankar sir, I'll just give it try to explain my understanding of this. So we are here to identify what is the cost of our capital. So the rate of interest which we pay is essentially the cost of that capital. So rate of interest we have identified. But do we actually pay that much rate of interest? We also reduce our tax on it because it is in the books of accounts. It is in the minus side, right? So we don't pay. We pay tax only on the profits, and before calculating profits, we deduct the interest and all those payments. So tax is not part of the cost. Hence, we keep it as one minus the taxation. So 9.5 into the 75% is
So
the
whatever. So
Correct.
basically, whatever the taxation amount that will get subtracted from the calculated amount, means one minus
Yeah.
tax amount.
yes, sir.
Is it so far?
Yes.
Yes, sir.
Okay. Thank you.
Okay. Any other doubts before I ask you doubts? Okay. So hopefully there are no doubts. So now, if you see, we have assumed that Prashant Limited is a listed company, and we have computed all this. So how to compute this for an unlisted company? Supposing that I have a private company, Chetan, what is it? The name of the company is just Chetan. That's it. Chetan Provisions, Chetan Groceries, Chetan Supermarket. It's a private company. It's not a listed company. Chetan Enterprises, Chetan Transport, or I may be having an industry called as Chetan Paints. So how do I compute cost of equity in such situations? Because you're not paying out dividend. Dividend is the drawings, what you're doing it. What if I'm not taking any drawings? I'm not making any drawings. I'm just reinvesting everything else into the business itself. So how to compute cost of equity at that point in time? Because everything else you can compute. Only the challenge comes up while computing the cost of capital, that is the cost of equity. Because your company is not a publicly traded firm. Since your firm is not publicly traded, you're not getting your beta. You can't compute the beta, right? So tell me how to do that.
So maybe in that case, there is no market value basically primarily, but there are a lot of unlisted companies that they're able to calculate the book values and basis that they equate it against market value. Is it okay if we take the book value in those cases?
No, there is no market value at all, right? For a company like Chetan Paints, okay, mine is a paint manufacturing company, but I don't have my company listed on the stock market. If my company is not being listed on the stock market, I don't have any prices. Okay, if I don't have the stock prices, how do you compute the regression beta? Through regression only the slope has come up, right? In other words, what I'm saying is, so you come here, you go to data analysis.
Can we consider the increase in their profit year on year for y-axis?
I go to regression. Just a minute, sir. I go to regression. So this is my y range. Sorry. This is my y range and this is my x range. Okay. So I got the beta 1.6. You can see it is the same. It is. So regression beta, right? That is the reason it is actually called as regression beta. It is. So you are saying something, sir. Sharat sir, please go ahead.
No, can we consider the change in percentage of their profit for y-axis?
No. Your guess is really nice, but that is not the way it is normally done. There are better ways of doing. Can you keep guessing it? Good. At least you tried it.
Profit with respect to investment.
Profit investment. Okay. Any other guessings? Yeah. Keep guessing. Let us see how many guesses will come out. The more guesses, good it is.
Capital increase overall.
Pardon?
Their capital, how much it has increased year on year.
Okay. Any other ways of doing it?
The tax paid over the years. In percentage of tax paid of the years.
Okay, percentage of tax will be more or less will be same only. If your corporate tax is 25%, it is not slab, it's all fixed, it is, right?
Sir, 1 second. So the equity for this cost of equity capital, we calculate it. Why do we calculate it in the first place?
Cost of equity we have to compute for computing cost of capital, right? That is one of the component.
No. Why is this why is this component relevant? Because see, other components are you are taking money to do some work or do something, right? These shares, this is because you are in future supposed to pay off your owners or equity holders. That is why you calculate it. Is that the reason? Why do we calculate this cost of equity capital?
Cost of equity we have computed. We want to know overall cost of capital. That is what the answer I can say you at this point in time. Is it? So because the cost of funds are actually even contributed by the equity owners as well, right? So how are you going to measure that? So the best measure what we have got for us is, okay, so the CAPM model, that is what we said, capital asset pricing model, and we said that that is how beta and that we'll be computing. Okay, so I'll answer this question. Slightly it is going to be a different thing. Okay, so what I'll do is, since mine is a paint manufacturing company, okay, so it has been believed that similar companies which are there in the same industry will be having the similar beta. Okay, so you have to understand that beta is not coming from the regression, first of all. Okay, so though we measure the beta through regression, you have to understand that the beta of a firm is determined by 3 variables actually. The first one is the type of business or businesses the firm is in. Okay, so that is how the beta is coming from actually. So I'll give you, I'll ask you a question. Okay, so the beta of Hindustan Unilever versus the beta of, let's say, Tata Motors. Okay, tell me whose beta will be less as per your understanding.
Tata Motors should be less.
Is it so? Think and tell me. One is a cyclical
Actually,
company. One is cyclical company, that is Tata Motors. If recession comes up, what happens to your company? Nobody will be having jobs. Majority will be not be having jobs, and because of which, what happens? So since you are afraid of whether you have job or not, you will not go out and buy a car. Versus the products of HUL. HUL products are your toothpaste, your daily grocery items, and all that.
So Tata Motors will have higher beta.
Is it not? So it is something like asking the beta of D-Mart versus the beta of Tata Motors companies. So we have not really checked those betas, but still you are able to say some answer that now because D-Mart beta will be or HUL's beta will be lesser than the Tata Motors beta. How do you came to know that? Because you know that now the risky businesses will be having higher betas.
Volatility.
So volatility will be more of such particular companies. Volatility will be more. So that is the reason.
More of those will not related to the basic needs or the
correct.
Those kind of companies.
Tata Motors the cars you will buy once you are actually done with your basic needs, right?
How does it relate to the government organizations like IOCL, NTPC?
Let us come to that, sir. But I'm telling you, I'm just giving you a brief information about betas are actually not coming from the regression. It is coming from the businesses what they're actually doing. That you have to understand in the first place. Okay, so let us discuss them later on. Okay, so the degree of operating leverage. What do you mean by operating leverage means? So how much fixed assets you have actually invested? Higher the fixed assets you have invested, the beta of such companies will be higher. For example, BHEL, BEL companies, beta will be much higher when compared to, let's say, for example, companies like less capital intensive, like let's say, for example, Zomato and others. Okay, because these are actually asset light models. The business model of these companies are asset light models, like because for example, Ola or Uber, they are not really having any sort of cars. Is it not? Somebody else's car that is being listed, and that's how they're actually making business, which means they're actually asset light models. In other words, if you have invested more into the fixed assets, you tend to have your beta on a higher side. Okay. And next is, it is coming from the company's financial leverage. The higher, the more amount of the money which you'll be borrowing, your company becomes more risky. Since your company is more risky, then what happens is your company's beta tend to be going up. So these are the three factors which determines the beta of this stock. Is it clear, everybody? It is not coming from the regression. Okay, it is only method of actually deriving the values of the beta from the stock prices. That's it. But if you really see, the betas are actually coming from, our beta is going to be getting affected from all the three parameters just now listed out here. Okay.
More beta means more risk.
Higher the beta, higher the risk it is. That is also we have discussed. Higher, more than one. Always your market beta is one. Is it not? Why is it we said market beta is always one? Because if you take X and Y variable both as your market, and if you run a regression, you get one only, right? Because you are actually doing regression with the same item. It is because of the reason market beta is always you are getting as one there. Okay. So now is we can see bottom of betas. It is. What is bottom of betas? These are the betas you will be computing when your stock is not a listed company. Okay. So what we do is, first of all, we will actually we will see how to do that, and then we'll come back and I'll give you this particular what is it, PDF. Will be sorry, this PPT will be able to understand on your own. Okay. Shall we go and do that? How to compute for a beta of an unlisted company? Okay. I'm just putting it as beta of unlisted company. Okay. So how to do that is, assuming that I'm doing for an Chetan Paint because it's into paints manufacturing business, right? What I should be doing is, so companies which are manufacturing paints in India, which are listed, I should be listing out here. I should be taking up the betas of such companies, and I should get debt by equity ratio. So these are the components I require. So assuming that I got some 10 companies that are listed, what I do is I will actually, sorry. It's not working. 3, 4, 5, 6, 7, 8, 9, 10. Okay. So assume that these are companies, names are actually A, B, C, D, E, F, and so on. So these are the names of the company I'll be taking up. Okay. So what should I do is I should actually take up the betas of all these company. Right now, what is the beta of these companies? So regression beta, you can actually compute regression betas, and it is nowadays it is available on money control and all that. You can actually take that. Okay. So I'm just assuming some betas for this. So the beta of this company, of these 10 companies, is this. Okay. So debt to equity ratio of these companies I'm taking up now. Debt to equity ratio is 0.3. Okay. These are the assumed values I'm taking up, which means I am actually taking up real 10 companies here, which are listed in India. And also I compute beta of those companies. You know how to compute, I'm just taking it. And take out, you can just see, if you visit the balance sheet of such companies, you will know what is the debt, total debt by total equity. Okay, you can take that ratio here. After taking this, what you should do is, you have to unlever it. Okay, so you should unlever the beta. So what is lever beta and unlever beta, I'll tell you in a moment. What is a levered beta? Levered beta means when your company becomes a levered company, first of all, you have to understand what is a levered company. When the company has got some debt in its capital structure, then it becomes a levered company. Understood? No? What is levered company? What is an unlevered company? Okay. So when a company does not have any debt in its capital structure, then it is called as an unlevered company. And beta of such companies is actually called as unlevered beta. Is it clear, everybody? What is unlevered and levered beta? So for example, Infosys don't have any debt in its capital structure. Okay, then because of this, the company's beta, we call it as unlevered beta. Is it clear, everybody? For example, State Bank of India has got debt in its capital structure, and the beta which is being computed by you, obviously called as levered beta. It is. That's it. There is no complication here. Okay, it is easy. It is. Okay, so a company, if it has got debt in its capital structure, then the beta coming from that particular company is called as what? Levered beta. It is. And if a company does not have any debt in its capital structure, if you compute beta, then that beta is called as what? Unlevered beta. It is. That's it. So now you tell me 1.5 beta, tell me whether it's a levered beta or unlevered beta.
It's levered beta.
Why you have said levered beta?
So there is some debt to equity ratio.
Because there is a debt here, because 0.3 is the debt to equity ratio. It is. For every 1 rupee of equity, you have got 30 paise debt there. Is it not? Some debt is there. That is the reason all these companies, okay, all these particular betas are actually called as levered betas. Is it clear, everybody?
Yes.
Why these are actually called as levered betas? I'll write here levered beta so that you'll be easy. It will be easy for you. Okay. Now we know the levered beta. Can we now act as if there is no debt in the capital structure? Then how much will be the beta of these companies? What we should do? we have to find out the unlevered beta for these companies. Which means what? As if we have to act as if
Debt is zero.
debt is zero. How to act? Which means there is an equation which I'll be directly imposing here, and I'll be doing that, and I'll be computing unlevered betas. Now it is easy. So I just go to one more sheet out here. I'll pick up the equation. Okay, so this is the equation. I'm just copying this from the other sheet. I'm pasting it. So how to compute unlevered beta? Beta levered divided by, this is beta levered divided by, divided by 1 plus 1 minus t multiplied by market value of debt divided by market value of equity. That is debt by equity. Okay. So what I do now is, so beta levered I should be taking this one divided by 1 plus 1 minus, I'm just writing the equation, that's it. So that is multiplied by market value of debt and equity. This debt by equity I have already taken up. No? So I am just doing that. I got this unlevered beta. Is it clear, everybody, what I did?
Is in place of market value of debt, what you have taken?
No, market value of debt by equity, this is given directly here.
Okay.
I just multiplied that, that's it. Clear? Any doubts so far? Okay. So now I'll compute this for all of this.
So T is 25. Where have you taken that?
Pardon?
1 minus T, 1 minus 25% you took right now.
Corporate tax is 25%. For your company, whatever the tax rate is there, you have to take that.
Okay.
While doing your project, whatever the tax rate is there, you have to take that. Is it fine?
Okay.
And sir, what is the significance of calculating this unlevered beta?
In next 2 minutes, you'll understand. Is it fine?
Okay.
Can you just go to E4, please? Just want to check one thing.
Pardon?
E4. E4. Yeah. Okay. And this D4. Okay. Thank you.
Okay. So what I did is I have actually acted as if there is no debt in the capital structure. Supposing there is no debt in the capital structure, what is the beta? That is what I have computed just now. Okay. So now what I'll do is I'll take average of this. So what is this? This is the average. This is industry average. Industry average unlevered beta. Do you agree with me? What I wrote here? Until this, have you understood what are we doing? So we have taken up the companies, we have noted down their betas, we noted down their debt to equity ratio, then we unlevered the beta, and we have taken the simple average of that. Why are we doing this? Because for my company XYZ Chetan Paints, it is a private company. So for private company, there is no beta which is readily available because my company is not being traded in the stock exchange. Okay. So how to compute this? RE is equal to RFR plus beta times beta multiplied by market return minus RFR. So this beta, I don't know for my Chetan Paints. If I know what is the beta for Chetan Paints, it is rather easy for me to compute cost of equity, RE. And every other component I can easily compute for my company. Is it clear, everybody? Why are we doing this? Okay. So now what I do is, what is the debt to equity ratio debt by equity for Chetan Paints, I know. What is the debt to equity ratio of Chetan Paints? It is 0.66. How I computed that? Debt by equity I did. I got that ratio ready with me. Okay. So now I should compute debt by equity means what? What
Sir, what
is
do
this
you
actually
mean
called as?
by what do you mean by equity unlisted company? It means, for example, there are 5 partners in this company. This is the money
The
invested by
amount
you.
contributed by 5 partners is equity.
Okay.
Right? Debt means the borrowed funds. Is it clear?
Sir, but from where did you get the debt by equity for Chetan Paints?
So this is assumed company. I have opened my books of accounts. I computed debt by equity. That is how I got 0.66.
Okay, it is assumed number.
No, it is not assumed, but in reality, this is how it is been done normally. 5 partners are there. That is what is the total equity, how much it has been contributed by them as equity it is. Debt means how much ever I borrowed money from bank. So that debt divided by equity, if I do that, I am getting 0.66. Though it has been assumed, there is a logic how it has come up here.
Sir, is this equity, I mean, for a listed company, is this the current price, based on the current price or the face value?
No, this is an unlisted company, and because of which you will not be having any market price, right? The money which has been invested, that becomes your book value will become equal to market value in this case.
Now, in this case, we have to take book value.
Book value, yes.
But otherwise, usually it is the market value.
Market value. That is the reason we have taken current market prices while computing the beta.
Understood, sir. Thank you.
Okay. So debt by equity for Chetan Paint, it is 0.66. Okay. So now, what should I do now is, I have to compute now the beta of my stock. How to compute the beta of my stock is, okay. So mine is what levered beta it is. So I have to unlever it now. Okay. How to unlever the beta it is? So unlever beta is equal to how to compute that? Just a second.
Instead of divide, we
You
will
know that this is a levered beta. Is it not? It is actually not a levered beta, sorry. This is actually what
unlevered.
means I want to compute a beta that should be unlevered. So that should be levered. I write here, I said, I want to compute a beta for my firm, which is a levered beta. Because there is a debt in the capital structure. Because there is a debt in the capital structure. Okay. So what I do now is, okay, so I have to compute a levered beta. How to compute levered beta? You can see here this equation. Levered beta is equal to unlevered beta multiplied by 1 plus. So which means this, I'll send it to my left hand side. Are you getting it what I'm saying? If I have to compute levered beta is equal to unlevered beta multiplied by whole of this thing which is there in the brackets, which is there in the numerator. Cross multiplication, that's it. Okay, so which beta I should be considering now? I should be considering now
average.
This one. Okay.
1.25.
So multiplied by 1 plus 1 minus 25% multiplied by this debt to equity ratio I'll be putting in. So I have computed a levered beta. Is it clear, everybody? And this beta I should be using.
D19, which you have multiplied? The last one?
Debt by equity. 0.66, which is applicable for my company, Chetan Paints.
Okay.
So what I did is I have actually come out with one beta, and that beta I can be using to compute this now, because written RFR is the same, it is marketed in it is the same, it is only item what I was not knowing is beta here, and I have computed this beta with this particular equation. Class, have you understood? I don't know. It is slightly tricky, but it is easy. It is okay. If I share this particular sheet, if you go through this once, you'll be able to understand. Yes, Dinesh sir, please go ahead.
No, I just said I understood. Thank you.
Okay. Okay. Yeah. Any doubts, class now? Since I do not have beta of my own, what I did is I have actually I borrowed the beta which are from the listed company, and I took the average of that, and I used that particular beta effectively for computation of my company's cost of equity, because it has been assumed that the similar companies belong to the similar industries will be having similar betas, more or less. Okay, so I am actually going by that particular what is it, academic research. I am actually adopting my beta here. That's it. Done, everybody? So we have got 8 more minutes. It's Sachin. Yeah.
Yeah, I was saying that can we assume the beta of listed companies to compare these or not? Because having the data of similar kind of unlisted companies debt to equity ratio, so that might not be available, or is it available?
No, debt to equity ratio for each company it is different, right? That is the reason.
Yeah, right.
If your company is, let's say, having 0.7 beta, you put here automatically you get what is the beta for your company. 0.7 is the debt to equity ratio. Automatically you get. Supposing that your debt to equity ratio is 0.9, put it that automatically you get it beta for your company. You have computed. So presuming that your company is into paint manufacturing industry. Clear?
So this 0.9 is for my company, for which we are calculating, right?
Pardon, man?
The number which you are changing, that is for my company, for which we are.
Yes. This is for the Preeti Paints, and for Preeti Paints, it is going to be 0.8. Assume that 0.8 is your debt equity ratio.
So that I'll have to calculate from debt and equity which I have.
Correct. Yes.
Sir, if the company is not publicly listed, then how we are going to achieve those numbers like debt to equity ratio for all the companies? Are they available publicly?
No, you have to, if you know debt to equity ratio of your own company, which is not listed one, that is what we did just now.
For me, sir, it's okay. For me, it's okay. But for the other companies which we have we have the 10 companies
These
on
are
top.
listed companies. I think that about data in this table is all listed companies based on which we have calculated the industry average.
Correct. These are actually listed companies.
All ABC,
Okay.
all these are listed.
For listed company, it is easy to get beta and debt by equity ratio, right?
Now clear, sir.
Yes. Fine. Shall I ask you questions now? So I have ready questions with me. Let me ask, which we already discussed. What is WACC? Quick.
Weighted average cost of capital.
Yeah, how to compute that? Some product, you know it. The market value of the cost of funds multiplied by weights.
Yes.
What is market value of equity? Quick.
The price, market price.
Market value of equity. Quick.
Number of shares into market.
Market price, number of
Market price. Very good. Next.
Market value of debt is equal to the is equal to book value. Book value.
What is market value of debt?
It's the market price on which the investors would like to buy the company's debt for the total
Debentures
amount of
market
debt.
price.
Number of
Debentures market price multiplied by number of debentures.
Rate of
Right?
Current market price, total amount of debt.
The current market price of the debentures multiplied by the number of
Total
debentures
amount of
outstanding.
outstanding debt.
Yes.
Shares multiplied by the current market value.
Okay. Anybody else?
Sum of the
All the 4
equity
parameters.
share capital plus debentures.
Yeah, all
Plus
the 4
term loans.
parameters we have added. No?
Yeah.
Yes.
That is actually going to be market value of the firm. It is very good.
Average.
Let's say equity divided by the market value, the market value of equity divided by the total market value of the.
Total value of the firm. Yes.
Individual
Okay.
weights divided by total weight.
Correct. Supposing that if you have got only equity and debt, in the denominator it is going to be market value of equity plus market value of debt it is.
Yeah.
Okay. Next.
It will be interchangeable.
Yeah.
Equity and debt.
Yeah. Next.
It reflects the today's value rather than the book value. I mean, it's more.
It is more relevant, and we should only consider market value weights only, not the book value weights.
It gives the current price as per the current price, current dated value.
Yeah. So it is actually going to give us the WACC today instead of WACC some other time in the past.
Right.
There are two methods. One was
Dividend cost model or
another was CAPM.
Capital assessed.
Yeah.
Like
You will
sharp
tell me
is
what is
CAPM.
Gordon's dividend discount model?
This is applicable to those companies which pay dividend, and that is the multiplication sum of current dividend, growth rate, and market price per share.
Market price. Yeah. So growth rate and dividends you should be computing. If you know that, everything else is given to you. That is current dividend, you know it, and the growth rate in dividend, you know it, you have computed it, and the market price of the dividend, you know it. Okay. So this is not going to be applicable for the growth companies, because predominantly what they do is they will declare less dividends, or they actually don't declare anything as dividend. Is it not? Especially the growth companies, for them it is not applicable. This particular model is not applicable. The second method is the second model is
Capital asset pricing model.
Pricing model.
capital asset pricing model. Very good. So how to compute that cost of equity using that model?
Based on the beta value.
RFR plus beta equals
RFR?
APR.
RFR plus beta into market return
ERP.
minus risk-free rate.
Yes. So
Equity risk premium.
yes. Risk premium. We know that is market return of the market minus risk rate, and we also discussed about various variations. What happens if you are going to take different risk rate? When to consider different risk rates? Also, we have discussed. Okay. So risk rates we can take it from Reserve Bank of India's website. We have discussed computation of beta. Also, we have discussed using slope function. Okay. Next.
For debt,
Interest expense, you have to take interest expense into 1 minus tax side by total debt.
Based on YTM.
YTM will be pre-tax.
If your
after
debt
that we
is
have to calculate
publicly
post
traded, it
tax.
is YTM. The pre-tax cost of debt will be your YTM, and you have to subtract out the tax rate so that you get the post-tax cost of debt. That is in case of the YTM method. It is. Second method is
Interest expenditure by
Interest expense into
into
1 minus tax
one
side by
minus
total debt.
very good. So you have understood both the methods now, right? Next is how to compute return of the market.
Ending index value minus beginning index value, and you have to add the dividends, and the whole component you have to divide by beginning index value.
Is it so?
So we have to calculate the return of the Nifty 50 or the index fund which you're planning, and
Since from the inception.
From the inception, then we take a geometric mean -1, and then if it is weekly or whatever, that we have to use.
Multiply. Yes. Good. Next is how to compute the ERP. We know, everybody knows.
Market
It's not
return
enterprise
minus
resource planning. It is going to be equity risk premium for India. It is. Fine.
Yes.
So what is the proxy for RFR?
This from RBI, this
the government bond.
government bonds. 10-year
Normally
government
we
bonds.
take a 10 years government bond yield. It is.
Yes.
Not the coupon rate. It is the yield. It is. Yield is YTM again. Okay. So next. This is very long question.
Yes.
We just now discussed.
The trick is to find the beta of unlisted company.
For all the listed companies, and then you have to average out. Okay. Then that beta you'll be using it, and you have to lever it and unlever it. All that we have just now discussed.
Keyword for
For company with
unlevered
but
for
one
no debt in capital structure.
capital structure.
Okay, if there is a debt in the capital structure, we call it as a levered beta.
Levered.
If there is no debt in the capital structure, it is called as unlevered beta.
Yes.
So that's all from my side for the cost of capital. Hope you have understood what is cost of capital in detail. Okay, so normally I take so many sessions, maybe another 2 sessions for my PGP students in doing it. But in a compressed manner, compactly, I have covered this without compromising any quality. Everybody has understood what I explained. Hopefully, it will be useful for your computation of the NPV and IRR. For the project discussion, it is going to be much more helpful there. Okay, thank you for being with me. So
Sir,
let us-
one question.
Yeah, go ahead.
In the project, you mentioned that choose a company which has at least some debt.
Yeah.
Wo-
I'll explain how to do it.
And listed company.
Listed company is okay, but what is the significance of the debt? We'll choose and we'll calculate data and all. WAC you have taught, we'll use that. But why is that company having debt important, or debt to ratio of less of at least of 0.5? You mentioned something.
Yeah, if there is some debt is there in the capital structure, then computation of cost of debt should also be there. Otherwise, what normally students will do is they will take up a company which is not any debt at all, and they will escape computing that cost of debt.
Normally, every company has got the debt, sir, isn't it?
Every company has some debt, but if you got 0.5 as a debt to equity ratio, at least you have got something to compute. So I'll explain how to do it, how to actually easily do it. Since you are asking me, I'm just create new screen. Go here. Market capitalization should be more than how much is it? 50,000. And debt to equity ratio should be greater than
0.5.
0.5. So you got 70 companies. Only these companies you should be able to take. Got it? How to do it? Or I have to explain once again?
No, understood, sir. My only question was why that condition.
That is a condition. Otherwise, people,
No,
students tend to take up, in my class at least, they'll go for very low debt company and they say it is no debt, sir. So we have excluded that. So that is the reason I have put that component. That's nothing.
And fifth one is already taken. So other groups may please skip Varun beverages.
Yeah. So Sachin, can you please ensure that no 2 groups will be doing the project in the same company?
I will.
Okay.
I will do.
Yeah.
All are requested to please send your companies at the earliest as soon as possible. Please don't wait for day after tomorrow.
Any other questions, or shall we wind up?
So just one question for the ERP.
Okay.
It's a very the ERP what we have calculated in the cost of equity. We have the two values there. One is the rate of return and one is the Nifty 50 return, and both are based on since inception of the data.
No, you have to take
So
either of them. That's it.
either so return of the we
Since
have
from the inception, we have to take since we have taken from 2007. Na? In first
one value we have calculated 9.09% and another we have calculated 14.2%.
Okay, I'll clear your doubt in one statement. So you compute Nifty 50's return since from the inception. Whatever it is, you take that. Forget about what we have computed.
Okay.
Next. Clear? Okay. Take care. We'll meet in the next session. Bye.